Today we are analyzing Gilead Sciences, ticker GILD. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. This company has a market cap of $98 billion, enterprise value of $114 billion. So you can see about $16 billion in net debt on this business. Not a significant amount. It's overall about 10 to 15% of the overall enterprise value. They are operating in the biotechnology industry. So Gilead Sciences discovers, develops, and commercializes medicines in the areas of unmet medical need, U.S., Europe, and internationally. It seems like we have some brand names of their products, and of course, because they are medical pharmaceutical products, they have very complex names: Biktarvy, Genvoya, Descovy, Odefsey, Truvada, etc., etc., etc. They have treatment for HIV and AIDS. They also have coronavirus disease treatments, hematology oncology, of course, that's cancer treatment, and then they have some hypertension and a few other treatments here as well. So they have collaborations with various other companies. That's also quite common in this industry. Beta of 0.41 is interesting because it's significantly lower than 1, which would be the average S&P 500 company. So that's going to tell you that they're going to be a little bit less volatile in the stock relative to the average S&P 500 company. Less volatile companies tend to be relatively higher quality, but not always. Return on invested capital is interesting. First off, you have 2 years here of losses, 2003, 2006, but otherwise it looks like they've been profitable every year since 2007. So 18 years of profitability. I really like 19 or 20, but 18 years is still quite good. One of the things that's really interesting, though, is they spend a lot of time with very, very high returns on invested capital. You see here in 2014, 2015, they were earning a 51% return on invested capital. Now, it's come down since then, and you're kind of hovering right around that 10% range. Overall, pretty good numbers here. Now, there is some stability strongly year to year, but you do see these drop-offs, and that's pretty common for pharmaceutical companies. Because of the patent cycle, you're going to see big ramp-ups in earnings, and that's what you see here 2013, 2014. When they get a blockbuster new drug, you could see skyrocketing profits, and then those could decline over time once they go off patent. So you have some cyclicality to the pharmaceutical business model just on an inherent basis. The way that the patents work, where you get exclusive ability to market your treatment, means that during patent exclusivity, the business quality of that product is extremely high. You have outstanding pricing power, incredible returns on capital. It's very, very expensive to produce the first pill, but very, very cheap to produce pills number 2 through 1 million, and that can really show up in their economics. But it does mean there's a little bit of a lottery effect. You're looking for the next big thing all the time. These companies might have to spend a lot on acquisitions, and so you can see a little bit into their capital allocation how that plays out. You see this pricing power, of course, in the 80% gross profit margins. That's really a top-line metric where once you start hitting 80%, you have extreme amounts of pricing power. That's pretty good. Also, you're seeing that their free cash flow, EBIT margins are hovering on this 40% range. That's incredible. Those are world-class type margins. Not uncommon for a very, very strong pharmaceutical company, but it is something that would be extremely uncommon through many other industries. A lot of industries, companies have gross profit margins below 40%, and this company has bottom line margins at 40%, so you can just see the big difference there as well. So your return on invested capital of 12%, very good, definitely hitting above my target of 10%. Return on equity of 27%, very good as well. So these are very strong numbers. What that allows you to do is that allows you to internally compound your growth. You see growth here of 10%, 11%, 11%, 8%. All these numbers can be allowed to grow and hit those margins without having to take on additional debt or having to issue a lot of shares. They're producing free cash flow. That free cash flow can self-fund all their growth, and that's a really good setup for a potential shareholder. PE ratio is relatively high. You have a PE of 21. One of the problems with analyzing PE for pharmaceutical companies is the fact that these companies have that inherent cyclicality of the patent cycle. When a patent goes off and then they have to face a lot of competition from generic providers, the performance of that product gets substantially worse. The profitability of the company can drop significantly in a short period of time. So pharmaceutical investing is not for the faint of heart because you have to really understand their key products. You need to understand their patent life cycles. You need to understand what they're doing to extend those patents and kind of what the overall long-term profitability of that product might be. Sometimes when these things go off patent, their sales drop almost to zero because they just simply can't compete with the generic marketplace. So you need to be aware of that because it makes it difficult to assess. Why am I saying that? It means that simply looking at the PE on its own doesn't tell us a lot, because I could say, oh, PE of 21, that's relatively high. I like to do 15 or less, but it could be that they're right before another big blockbuster, and then the true PE of what they're earning today could be like a PE of 4, as their earnings would skyrocket if they get another big blockbuster. So you really don't know in advance with these types of companies. The way that pharmaceutical investing works generally well is if you have kind of a shotgun approach, you're addressing multiple ones. They're trying to get a lot of different products underneath the same umbrella to kind of reduce that volatility in the underlying business model. But just something to be aware of, you can't simply look at the bottom line market on companies like this because of that inherent volatility and how this patent cycle works. You can see that as well here. 2014, 2015, their gross margin went up to 85, 87%, and it's kind of trended down since then to the 79 range as they've had to deal with a little more competition since that peak time when that market launched. You can also see kind of, although their revenue growth rate looks really good, 10-11% revenue growth rate is outstanding. It would be something that I would be really interested in owning when you have revenue growth rate like that. But when we look at what's actually happening on a year-to-year basis, we see in 2013 you have $11.2 billion. You basically more than doubled your revenue in 2014. You 3x'd your earnings in 2014. You had a 30% growth in 2015, but since then you've had much worse growth. You've had declining years, 3 years in a row. You went from a peak of $32 billion in revenue down to $27 billion in revenue. And that's just because, again, that cyclical nature of the business. There's not much the management team can do about that. The problem for you as an investor is it's really hard to predict these sorts of companies. To me, that is an inherent negative on their quality. Gilead is a particularly interesting company to me because I have owned shares in Gilead's in the past, and I no longer do today. One of the things that made me sell was that I found it hard to predict their future. And it was mainly because it's like you have these really good products, you have these really good things in the development line, but it's hard to understand, what's the capital allocation going to be? How much acquisition money do they have to spend in order to spread out into different areas? And what are you paying for that? Because the growth nature is really hard to predict. I mean, just look at this period from 2016 to 2022. You say you grow at 10, 11% a year, but you have 2 years in that time period where that's true, 2020, 2021. Every other year is lower than that, and 4 of those years were actually a decline. 2022 is basically flat. Maybe you say 2 years flat, 3 years decline, and 2 years of growth. That's not the picture that I get when I think of an 11% growth company, and I think that was the struggle that I had. I don't remember exactly when I bought, but I wouldn't be surprised if it was in this time frame, 2014, 2016, where I was kind of thinking about these new products that they had, really thinking about how profitable that could be. I know I really liked the business they were in and treating HIV and AIDS. They have some very incredible, life-changing products for those patients. And so, in terms of the good they're doing for the world is very high. It's just very hard to predict for me as a shareholder. So let's dive into the income statement to learn a little bit more. If you're learning something, if you like what I'm covering here in Gilead, please hit that like button. And we're going to continue with the financial statements. So income statement. Again, I just want to highlight cost of goods sold to revenue. I mean, look at this. Their cost of goods sold went up 50%, but their revenue went up over double. And so you tripled their gross profit almost in a single year. It's just absolutely amazing numbers here that you can go from 2.8 billion cost of goods sold to 4 billion cost of goods sold. When you're making these pills, you're making these treatments, it's not about cost of goods sold. It's really about your research dollars. Those are pretty steady. You tend to be researching all the time, constantly spending money on R&D. And then, of course, your SG&A is something that the capital allocation has to manage well. You can see that they've kind of stabilized in this 20 billion gross profit range. And of course, and they've continued to grow their operating expenses, and so you've had their operating profit kind of come down a little bit over time. But anytime you're spending $5 billion a year in R&D, that is your future pipeline. That's your future growth. So it's something to be aware of there. One of the things I really like what I see on this statement is the shares diluted have gone down a lot over time. 1.7 billion in shares outstanding down to 1.26. So what is that? 30% reduction in shares over the course of a decade. That's really good. You're adding somewhere between 2 to 4% per year in your shares outstanding, or to your EPS growth rate because of that. And so that's a really good setup. You can see that they've doubled their EPS over the course of a decade. Pretty good returns to double your EPS in a decade. It's only about 7 to 8% growth. But again, that's not unreasonable for a company of this size. Again, we said it's about a $100 billion type company. Balance sheet. One thing I want to draw your eye to is this PP&E was 1.1 billion. You went to 5 billion. But overall, that 5 billion PP&E is compared to a $63 billion market, balance sheet is not that big. Inventories is not that big. You almost have cash equivalent to your PP&E. Really, the assets are coming in goodwill and intangibles. And what that is this, it's just constant acquisitions in this sort of business. They have to acquire new products. You can get new products either by researching it yourself or purchasing a company that has the products that you want and then continuing to employ those researchers, continuing to grow the product line. It's just common that the big pharmaceutical companies kind of spread steadily out using this method. So you would see this big intangible asset line that's pretty common. Short-term debt, 2.2 billion. Long-term debt, 22 billion. It is interesting. So they had $30 billion in long-term debt, kind of peaked in 2017. Looks like that ties in with these acquisitions. They made a big acquisition 2017, 2016 here. So you can see there's big increases in debt, and they've kind of paid it down since then, which is a good sign. I don't really like, huge amounts of long-term debt here. Let's compare this. So 22, 2.2, so they're about $25 billion. They're earning about so they have like 4 to 5 years in net income in debt. So that's a significant amount. I mean, you're talking about 4 to 5 years of your income in debt. It's going to take a long time to pay that down. That means this is an incredibly leveraged company, compared to shareholders. Cash flow statement. One positive sign you have, again, positive cash flow every single year. They're reinvesting a lot. You have a $10 billion acquisition here in 2017, $25 billion acquisition in 2020. You have pretty steady small acquisitions those other years here as well. But they're not tiny. I mean, 4.2 billion, 1.5 billion, 1.8 billion. One of the things that's always a struggle, though, is when you think about these acquisitions, a lot of times when you're acquiring assets, you might be acquiring assets substantially in front of the years when you can actually monetize them. And you don't always know with certainty that you're going to be able to monetize them. Maybe you buy a company before the product has passed its phase 2 or phase 3 study, which would be the phase 3, of course, being the last study before they could actually go and monetize it to the market. And so when you buy it, there's a little bit of a gamble, there's a little bit of risk. You might not have a monetizable product at the end. There is a little bit of that like lottery factor as well. And you think about like these total acquisitions here, this is $40 billion in acquisitions, maybe $45 billion in acquisitions over the course of that period. Now they've made a lot of income, so they've certainly used their cash to do that. But, the question is are they getting the return yet on those investments? Are we going to see it in the future? And that requires just, again, a little bit deeper of an analysis that you'd want to go into. Again, you don't really have a consistent pay down of debt thing. You do have constant buybacks, but it's important to draw your attention to that hasn't been constant retirement of shares. You see the stock-based compensation is actually quite significant. You're up to $600 million in stock-based compensation every year. That's a significant amount because you almost always are going to have to pay more to buy back those shares than you paid to issue them. And so you're thinking you're going to have to be doing at least $1 billion in buybacks just to offset the dilution. And that's kind of what you see here in this 4-year period. If we go back to the income statement, you can see that the dilution's really slowed down over those 4 years. I mean, you're basically flat on shares over that 4-year period, even though you've been putting a lot of money into those buybacks. I mean, you've put $4 billion into buybacks and it's just gone. It's just gone. It's not really retiring shares because of how much stock-based compensation. The time where they really retired shares was this 2014 to 2016 period where they had all that excess cash. And this is a huge difference when you're paying $10 billion in buybacks versus $300 million in stock-based compensation. So just be aware of that. They're not steadily buying back shares all the time like you may want to see. overall, I think Gilead is a very interesting company. I think they're doing some really interesting, cool things in the world with some of their products really making a difference in patients' lives. Again, I've looked at this company a little bit before, but it has been a few years since I've done an analysis on it. I had sold it some period ago. I can't remember. It's probably, again, in that 5-year time frame, maybe at least, since I've owned this stock. And when I sold it, the reason I sold it was, the growth wasn't there. I couldn't really predict the buybacks. I wasn't getting the share reduction that I wanted to see, because I was like, oh, they're going to be buying back shares. I'm going to see share reductions, and I never really saw it. And I think when I look at this now 5 years later, that continues to be true. I don't think the stock price is up much from when I sold it 5 years ago. So I think it was certainly probably a good decision that I sold. It doesn't mean that holding into the future won't be a good thing, but I do think for me, this company is quite big. It's very unpredictable, and so for that reason, it's not going to go on my watch list. If you learned something, hit that like button. Please subscribe. I welcome your subscriptions. Helps us YouTube know you're enjoying my content. I'm working through every company in S&P 500, so stick around for that. And if you want to study companies like this, it is quickfs.net. My affiliate link is in the description below. I hope you will check that out. And again, watch list, stocks, my favorite companies that I've covered already, they're in the playlist up above. Thank you for listening, and until next time, stop paying fees, start building wealth.